Hello friends. Welcome to our channel. Hope you are doing well, healthy and safe. Let's start today's video on why one should not stop their SIPs when markets are falling. Daily ups and downs in financial markets are a common thing known to investors. However, how you react and act when your fund turns red says a lot about you as an investor. It's good to remember that equity markets will be more often than not volatile. Knowing what makes it volatile, knowing why the markets are falling can hold the key to your anxiety. The question to ask is, does your fund's performance reflect a fundamental change which may be a good enough reason for you to stop your SIP or redeem your investments? What if it is a case of negative market sentiment like the current scenario of rupee depreciation, crude oil prices hike, upcoming Lok Sabha elections, etc.? The phase when you see your investments hit a bear phase is always a hard and emotional one. It is psychologically difficult and hard to accept. The best we can do is to analyze what we tend to do during market downfall, and what needs to be done. Why we shouldn't stop SIP in a falling market. It can be quite tough to stomach the volatility of the funds you have invested in. During volatile times, SIPs seem to stop and redemptions go up both quite prematurely. Behavioral experts state that investors feel losses more than higher returns. In order to not face any more losses, they tend to stop the SIPs or redeem the invested amount when the markets show a bear phase. But volatility is your friend if you are a long-time investor. Let us understand the concept of SIP with an example and how it works in the long term. No matter how volatile the markets get, experts advise you to continue your SIPs and benefit from them. But have you ever wondered how this works? Let's find out. But before that, a quick reminder, if you want to watch more videos like these, make sure you click the subscribe button and hit the notification bell. Your likes will give us motivation to bring useful videos and learn more. Okay, now let us move on with our video. How do SIPs help you benefit from market corrections? To make this really easy to understand, we will take an example of an investor who invested in a consistent fund. He started a SIP in January 2007. We will split his investment journey into 3 phases to see what happened. Phase 1 is the rising or bull market. Phase 2 is the falling or bear market. Phase 3 is the recovery and growth phase. Markets at that time were in the middle of a bull run and no one had imagined a big bust coming at that time. Let's look at how he invested and what his portfolio looked like in the next few months as markets kept going up. Focus your attention on the units received column. The number of units he is getting every month for the same cost is going down, from 54.48 units in January 2007 to 32.43 in January 2008. This is because the market kept moving up, and this meant he was earning some incredible returns. It also meant the new investments were happening at a higher cost. As a result, the average cost unit for this period also increased. Then came the phase of market corrections, which started in February 2008 and continued till January 2009. The investor continued his SIP, expecting the trend to continue, but then came the market crash. Despite this, he persevered, and here's how the investments looked during this period. In this table also, look at the units received column. For February 2008, the number of units he got was 39.3 compared to 32.43 for the same amount he got in January 2008. From February 2008, the number of units he received continuously increased and reached to 83.11 in January 2009. In the example, he invested the same amount in both rising and falling markets but got around 118 more units when the markets were correcting. This is like a discount you get in a sale season where you get more for the same money spent. Yes, the market fell, and it meant that the overall portfolio was in red, but it set him up for higher returns. As you can see, SIPs ensure you get more units at the same price when the markets correct. From March 2009, the markets started recovering and eventually moved up. In this phase, the benefits of extra units the investor collected becomes visible. These extra units ensured that the overall returns of the portfolio were far more than what he would have earned had he stopped his SIP when markets started falling. Here is a comparison table that shows overall returns in June 2010 with and without those extra units, despite the significant market correction in 2008, when more than 50% of his portfolio's value got wiped out in just 14 months. The investor still got a 13% average annual return on his investments. This is because, in a falling market, SIPs bring your average purchase cost down as more units get accumulated, so when the markets bounce back, the profit generated by your investments are higher. So, markets falling and rising is a reality every equity investor has to accept. However, you should not fear volatility but look at the downturn as an opportunity. Let's conclude this video by summarizing the benefits of SIP. 1. SIPs are lighter on your pockets. 2. You do not need to time the markets. 3. Helps rupee cost averaging. 4. SIP over long periods will compound or multiply. 5. Helps in planning your financial goals. So, please like the video, share it with your family and friends and subscribe to our channel. Thanks for watching and we'll see you soon.